Imagine a world where your money works harder than you do, earning for you while you sleep, while you travel, while you build your dreams. In 2025, that world isn't just possible. It's here, and the key to unlocking it lies in one simple strategy: owning the right dividend stocks. When most new investors look for dividend stocks, their eyes immediately go to the yield percentage. It's easy to be tempted by a company offering 8% or even 10% returns annually. But here's the catch: high yields can be a trap. Often, they signal that the stock price has fallen dramatically due to deeper issues in the business, and if a company's earnings are unstable, those big payouts can disappear overnight. That's why, instead of chasing the highest yield, you should be looking for dividend growth. Dividend growth refers to a company's ability to consistently increase its dividend payments year after year. Think of it like a tree that keeps producing more fruit each season, not just giving you the same basket over and over. This growth shows the company is not only profitable, but also confident in its long-term earnings potential. It's a sign of stability and strength, especially during uncertain market conditions. Companies that prioritize growing their dividends tend to have strong leadership, disciplined financial strategies, and sustainable business models. They're not just handing out profits. They're strategically reinvesting in their operations while rewarding shareholders. This balance between paying dividends and funding growth is what makes them reliable over decades. Another reason to prioritize dividend growth is the power of compounding. When your dividend payments increase every year and you reinvest them, your wealth snowballs at an accelerating pace. Even a modest yield can turn into a substantial income stream over time if it's growing steadily. The difference between a stagnant 5% yield and a growing 3% yield over 20 years can be massive in total return. In short, dividend growth is a far more powerful long-term wealth building strategy than simply hunting for the biggest yield you can find. It's about finding companies that treat their shareholders like long-term partners, not just temporary investors chasing quick payouts. One of the smartest moves for building a reliable passive income portfolio is to focus on industries that can withstand economic downturns. These are known as recession-resistant sectors, areas of the market where demand remains steady even when the economy slows down. The reason is simple. People and businesses still need certain products and services regardless of market conditions. When you invest in these sectors, you give yourself a safety net against the volatility that often shakes the stock market. Industries like utilities, consumer staples, and healthcare are prime examples. Utilities provide essential services like electricity, water, and gas, things people can't simply stop using. Consumer staples cover products such as food, beverages, and household goods, which remain in demand whether the economy is booming or struggling. Healthcare is another fortress. Like industry, no matter what happens in the markets, people still require medical treatment, prescription drugs, and healthcare services. These sectors tend to be less glamorous than tech or luxury goods, but their stability makes them incredibly valuable for dividend investors. Companies in these industries usually have consistent revenue streams, which in turn allows them to pay and grow dividends even during recessions. This reliability is why many professional investors anchor their portfolios around recession-resistant stocks. Moreover, these industries often enjoy pricing power, the ability to pass increased costs on to customers without losing significant sales. This protects profit margins and ensures dividends remain secure, even when inflation or supply chain disruptions occur. Over time, this stability can compound into substantial returns, especially when combined with dividend reinvestment strategies. By prioritizing recession-resistant sectors in your portfolio, you're not just chasing income, you're building a durable foundation. It's about owning companies that can weather storms while keeping your passive income flowing, no matter what challenges the economy throws your way. When evaluating dividend stocks, one of the most important metrics to consider is free cash flow (FCF). Free cash flow is the money a company has left after covering its operating expenses and capital expenditures. In simple terms, it's the cash that's truly free to be used for shareholder rewards like dividends, share buybacks, or reinvestment in the business. Without strong free cash flow, a company's ability to maintain or grow its dividend payments becomes uncertain. Many companies can post impressive revenue numbers, but revenue alone doesn't pay dividends. Cash does. If a business is generating high sales, but all the money is tied up in debt repayments, expansion projects, or other costs, there may be little left to distribute to shareholders. On the other hand, a company with consistent and growing free cash flow signals operational efficiency, strong profitability, and financial discipline. Strong free cash flow also acts as a cushion during tough economic times. When the market slows or unexpected expenses arise, businesses with healthy cash reserves can continue rewarding shareholders without cutting dividends. This is why many experienced investors prefer to dig into cash flow statements rather than just glancing at earnings reports or payout ratios. Another advantage of companies with robust free cash flow is flexibility. They can choose to reinvest in innovation, acquire competitors, or expand into new markets, moves that can further boost profitability and eventually dividend payouts. Over time, this creates a positive cycle. Solid operations lead to higher cash flow, which funds both business growth and shareholder rewards. In essence, free cash flow is the lifeblood of dividend investing. It's the clearest sign that a company isn't just surviving, it's thriving. When you build your passive income strategy around businesses with strong free cash flow, you're setting yourself up for consistent, dependable returns year after year. Debt can be a useful tool for growth, but too much of it can put a company and its dividend payouts at serious risk. That's why experienced investors pay close attention to a company's debt-to-equity ratio, which measures how much debt a business has compared to its shareholder equity. A lower ratio generally signals that a company is financing its operations and growth more through its own earnings rather than borrowed money. This financial stability becomes especially important during economic downturns or periods of rising interest rates. When a company carries heavy debt, a significant portion of its cash flow goes toward interest payments instead of rewarding shareholders. Worse, in challenging market conditions, high debt levels can force management to slash or even suspend dividend payments just to stay afloat. On the other hand, companies with low debt have more flexibility to maintain and even grow their dividends regardless of short-term economic pressures. Low debt-equity ratios also give companies more room to maneuver strategically. They can borrow responsibly for expansion projects without endangering their dividend policy. This ability to make growth decisions from a position of strength rather than desperation often leads to better long-term returns for shareholders. It's worth noting that the right debt level can vary by industry. For example, utility companies often carry higher debt due to infrastructure demands, while tech firms might operate with minimal borrowing. The key is to compare companies within the same sector and identify those that manage debt efficiently while still delivering strong returns. By prioritizing businesses with healthy balance sheets and low debt burdens, you're effectively lowering your risk. These companies are more likely to remain steady dividend payers during market turbulence, giving you a reliable stream of passive income no matter what the economy throws your way. One of the most powerful, yet often underestimated, strategies in dividend investing is reinvestment. Instead of spending your dividend payments right away, you put them back into buying more shares of the same company. This is commonly done through a dividend reinvestment plan DRIP, which automatically uses your payouts to purchase additional shares, sometimes even at a discounted price and without brokerage fees. Over time, this creates a compounding effect that can turn a modest investment into a substantial source of income. The magic lies in how compounding accelerates growth. When you reinvest dividends, you increase the number of shares you own. Those extra shares then generate their own dividends, which you reinvest again, creating a self-feeding cycle of growth. It's like planting a tree that produces seeds, and every time you plant those seeds, you grow more trees, all of which bear fruit. Eventually, the income becomes larger and larger, even if the stock price doesn't move dramatically. Reinvestment also helps smooth out the effects of market volatility. Since you're buying more shares at regular intervals, you automatically purchase more when prices are low and fewer when prices are high. This is known as dollar cost averaging. Over time, this can reduce your average cost per share and boost your overall returns. Many of the world's most successful long-term investors rely heavily on reinvestment because it allows wealth to snowball without requiring constant additional capital. Even if you start small, the habit of reinvesting dividends can lead to exponential growth over decades. By making reinvestment a core part of your dividend strategy, you transform passive income into a long-term wealth-building engine. Instead of just collecting quarterly payouts, you're putting every dollar to work, compounding your income potential year after year, and moving closer to financial independence without lifting a finger. Passive income through dividend investing isn't just about picking stocks. It's about building a strategy that works in any market. By focusing on consistent dividend growth, targeting recession-resistant sectors, prioritizing companies with strong free cash flow, keeping an eye on low debt levels, and reinvesting every payout, you create a portfolio designed for long-term stability and exponential growth. In 2025 and beyond, the right dividend stocks can become more than an investment. They can be the foundation for financial freedom. The earlier you start, the more time your money has to compound, and the closer you get to living life on your own terms. Your future self will thank you for every wise choice you make today. If you found this video helpful, hit the like button, subscribe, and turn on the bell icon so you never miss an update.